Welcome to this explainer. I'm putting on my expert investment analyst hat today because we are unpacking a truly fascinating corporate finance story. We're looking at Liberty Latin America, often just called LILA, and their Q1 2026 results. We are going to peel back the layers of their balance sheet to uncover the true health of this business. Because, beneath the headline numbers, there is a high-stakes balancing act going on here between aggressive capital returns and some incredibly heavy debt. And hey, everything we are exploring today is grounded in cold, hard data. We're pulling directly from LILA's own Q1 earnings presentation and cross-referencing that with verified financial metrics from MLQ.ai and Wall Street analyst forecasts. So no guesswork here, just the raw data and what it actually means for investors. Okay, here's our roadmap. We'll quickly run through the Q1 financial snapshot, hit the segment highlights, break down their preferred stock strategy, decode that debt load, and finally, weigh all of this against Wall Street's forecasts. Let's get into it. Part 1. The Q1 2026 financial snapshot. Let's zoom out and look at the macro view of LILA's performance. The company reported a massive $1.08 billion in Q1 revenue. Now, while that is technically flat year over year, it firmly establishes the sheer scale of their operations. I mean, they're a massive telecom player across over 20 countries in the region, so they definitely have the scale. But the real question for us as analysts is, are they actually growing the core business? Well, the answer lies right here. Crucially, they secured 50,000 postpaid net additions in just one quarter. If you follow telecom, you know postpaid subscribers are literally the holy grail. They mean recurring, sticky revenue. Grabbing 50,000 of them, that indicates a very strong start to the year and proves their commercial engines are absolutely firing. And management knows it. CEO Balaner specifically pointed out that all segments contributed positively to this subscriber growth. He's using this to signal to the market that, hey, the underlying business operations are healthy and our commercial strategy is working across the board. Moving on to Part 2, segment highlights and headwinds. Because when you operate in dozens of countries, regional performance is almost never uniform. It is quite literally a tale of two regions right now. Puerto Rico showed incredible momentum with a 12% jump in revenue. But on the flip side, the Caribbean segment actually shrank by 6% year over year. So what exactly drove this divergence? Well, Puerto Rico's operational recovery is flying high, mostly thanks to smart cost-cutting and a normalization in bad debt. Meanwhile, the Caribbean just got slammed by Mother Nature. Hurricane Melissa caused a severe $13 million headwind to their adjusted OIBDA. And remember, OIBDA is essentially their core operating profitability before factoring in depreciation. It is a really stark reminder of the physical, real-world risks that telecom infrastructure faces every single year. Let's pivot to Part 3, the preferred stock strategy. This is where the corporate finance story gets incredibly interesting, especially if you're a shareholder. LILA is engaging in some very aggressive financial engineering here. They announced the intent to distribute $500 million in preferred stock directly to shareholders. And get this, it carries a very attractive 9% dividend rate. Management says it's about re-gearing common equity to unlock value, pairing this with their first stock repurchases since early 2024. They are literally throwing cash back at shareholders. But as an analyst, you have to ask, how on earth can they afford it? Which brings us to Part 4, decoding the debt load. We simply can't talk about LILA's aggressive capital returns without addressing the giant elephant in the room. Let's apply some classic value investing frameworks here. If we look at this through Benjamin Graham's defensive checklist or Warren Buffett's strict rules on manageable debt, massive alarm bells are going off right now. Just look at a staggering 14.71 debt-to-equity ratio for fiscal year 2025. That is a massive jump from previous years, and it blatantly signifies that the company is relying heavily on debt to finance its growth. Neither Buffett nor Graham would love that leverage. To put that leverage into an operational context, their total debt and finance lease obligations compared to operating income sits at a heavy 15.6 times. They hold over $8.4 billion in debt. The tension here is palpable, isn't it? You have a company carrying an absolute mountain of obligations, yet they feel confident enough in their future free cash flows to hand out a 9% preferred dividend. It's a high-wire act for sure. Finally, Part 5, Wall Street growth forecasts. How does the broader market weigh 50,000 new subscribers against $8.4 billion in debt? Well, despite all that heavy debt, analysts polled by S&P Global are decidedly optimistic. They project an average one-year price target of $10.07. From the current price levels, that represents a really impressive 34% upside. Even the most aggressive forecast sees a potential surge of almost 63%. The consensus remains a solid buy. So what's fueling this optimism? It all comes down to profitability expectations. Analysts are projecting EPS, earnings per share growth of an astounding 323% this coming year. In classic Peter Lynch terms, Wall Street is viewing this as a massive turnaround play. The market believes that LILAK's cost-cutting, combined with that new preferred stock strategy, is going to ultimately supercharge their earnings. So, synthesizing all of this, it leaves us with one critical question to ponder. Will this high-leverage, high-reward balancing act actually unlock true shareholder value? Or is that $8.4 billion debt anchor simply too heavy to drag? The telecom business requires constant capital-intensive reinvestment, and managing that alongside a 9% dividend will absolutely be LILAK's ultimate test. Based on the frameworks we've discussed today, are you comfortable with that level of risk? Think about it. Thanks so much for joining me on this explainer to explore the real data behind the headlines. See you next time.